Hello and welcome to this week's episode for SPY Trader Now. I am your host. My name is Ken and our model portfolio is up 33.89% year to date. We have a yellow for the stock market strength color signal, and stay tuned so I can show you why that has turned from green to yellow for this week, which is surprising because the S&P 500 is at all-time highs. Okay, here on this channel, SPY Trader Now, what we do is our number one goal is to beat the returns of the S&P 500 buy and hold investor. Their portfolio is up 27.88% year to date, and we are at 33.89. So we are ecstatic that we are beating them by more than 5%, and we are ecstatic that we are in the triple digits this year so far year to date. All right, this is going to be an intra-month video, so I try to make it shorter content, not a longer duration than the full end-of-the-month videos. What we are going to cover in this video, it's for retail investors / traders who want to beat the market. We do a deep dive into the technical analysis of the S&P 500. We not only do the technical analysis, but we show you exactly how we trade our model portfolio and share with you how we produce our decisions. This is the difference between this channel and other channels that look at the market and show you the charts of the market. We not only show you the charts, but we have a model portfolio to show you how we're trading it in order to get to the returns that we are getting. And we're using investment capital with this strategy. Okay. And I'm not even sure if there's another YouTuber out there that is this transparent on YouTube that shows you exactly not only the charts, but the trades and how well they're doing against the benchmark of the S&P 500. Okay, we're going to do a review of last week's trades. We're going to show you the chart of the portfolio equity curve compared against the benchmark S&P 500. I'm going to show you CNN Business Fear and Greed Index, go over seasonality, and then at the end, market summation, closing thoughts, and next trades. Let's move on. Last week, the S&P 500 gained 0.87%. Now, this is a weekly chart with a 5-year duration candlestick chart. What I want to point out to you in this chart is the rising wedge pattern I have identified with this resistance line in blue and this support line in pink. We are currently right at the upper edge of the blue resistance line right there. Now I have a line drawn in here, which is this line right here, which represents the distance from the high point here of the wedge coming down to the support right here. And I've carried that over here. So this way, if this S&P 500 were to start to fall below this support line, this is how much we technically could fall. So we could easily see a number of 530 in the short term. Now, that's on the bearish side of things. On the bullish side of things, you had a negative divergence on the MACD here compared to the price action moving higher there. But we have broken, the MACD has broken above this resistance line, alleviating that negative divergence. Okay, here are last week's trades. We sent out 2 trades on Thursday, December 5th at 9:22 a.m. to our subscribers. This is Pacific Standard Time. Now, here are the trades. First, what we're going to do is we're going to buy 200 shares of SPY at the market. At that time, it was trading at 608.04. And then place 2 in the money covered calls because I'm feeling slightly bearish about the market, but not too crazy. Look at my strike. The strike was only 605, purchase price was 608. So, I mean, just 3 points lower than the purchase price with this very short-term expiration. This expires on Friday of next week. And we did get paid, because this was sell to open, $5.79 per share. Here's the exact trade right here, and we got paid $1,158 for that trade. Now I want to go into the reasoning behind the trade. Now, here is a 10-day candlestick chart for the S&P 500. And by the way, you know, we use the ETF SPY spiders chart for a lot of our charts here. So when we refer to the S&P 500, we're talking about SPY, spiders, all the same thing. It's just this is in an ETF format, easily tradable compared to a mutual fund or something like that. With an ETF, you can trade that intraday just like a stock. Okay, now here we are looking at the last 5 candles: Monday, Tuesday, Wednesday, Thursday, and Friday. On Thursday is the day that I made my decision to purchase. Why did I make that decision? Because of this candle right here. This candle on Wednesday, when it broke up, it broke out and up, making new all-time highs. It looked very bullish. The Fed, made some statements that it looked like things were looking good for the economy. The market liked what the Fed Chair Jerome Powell had to say, and the market was bullish. So then I went, in the very next day, went and made the transaction that I just told you about. And that is the psychology behind that decision and why I made that particular trade. I'm not too bullish, I'm not too bearish at that time, so I decided to go ahead and take this position on. But I've since changed my mind. I'm going to show you that at the end of the video, and during the video, why I have changed my mind. Okay, here are some of the trades that we've made in 2024. If you want to see all of my trades going back for the last 3 years, you can head over to this website. There will be a link for it in the description down below. Now, the yellow represents my current open positions, and these positions were put on 12/5/24. Okay, so the top one here is when we purchased the 200 shares at 608.04 for $121,000, and that's where we stand right now. The market is currently at 607.81, so we're upside down in that purchase by $46. The next one was the in the money covered call, 200 shares, and we got paid $5.79. We haven't closed the position, it's still open, but the shares are currently worth $4.90. So we're actually profitable by $178 in the money covered call. If you want to see how I do this week after week, what I want you to do is I want you to hit that like button down for me right now, subscribe to this channel, and ring that bell to be notified when I post a new video. Now we are looking at the equity curve of our model portfolio in blue compared to the benchmark, the S&P 500 in pink. You can see that we are surpassing them, which is our whole goal here. And you can see the percentage returns right here at the bottom of the screen. One thing I'm going to point out is on our blue equity curve, notice how slow, steady, and rising our curve is. It's a beautiful equity curve you want in any portfolio. Now we are looking at a ratio chart. This is the NASDAQ 100 against the S&P 500. And the ratio chart is the one that is in red and black that I'm pointing to right now. I also have in blue the S&P 500 SPY and the NASDAQ 100 symbol QQQ right here. You can see that both the S&P and the cubes are both just traveling north like this right now. What is the ratio chart doing? It was in this trading pattern here, hit a bottom right there, and since that bottom has gone straight up, it is just moving completely straight up, okay? So with that, that's telling you you've got risk on. This ratio chart is showing you risk on at this time, which is good for both the NASDAQ 100 and the S&P 500. The only caveat I'm going to say here is that you'll notice this resistance line here, and you'll notice the distance from here to here is not that much distance. So in other words, we can continue to go higher, but the closer you get to this blue line, the closer you are to having a reversal, just like we did here, 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 and here. So how much we can squeeze out of this run is beginning to be very limited. Now we are looking at the VIX volatility or fear index, 3 levels. Above this green line, upper range bearish. Below this green line is the low range bullish when it's between these two. Below this green line is the ultra low range, which is also bullish. We are in the ultra low range right now, which is a bullish signal, okay? The MACD is below its signal line, bullish. Slow stochastics losing momentum, heading south, bullish. The only thing is that on these cycle brackets that I have drawn in here, we are nearing or at a cycle low right now. And if this energy starts going up, this is going to start pushing that up. And when that works inversely to the S&P 500, that's going to come down if that were to happen. But it has not happened, and so far it's bullish. Now we are looking at Warren Buffett, the Oracle of Omaha, and we are looking at the CNN Business Fear and Greed Index. Currently, we are in neutral. 1 week ago, we were in greed, 67. Amazingly enough, with the market the way and where it's at right now, it is becoming, it is not in a greed state. It is coming down to a neutral state. So amazing. Just sharing that information with you. All right, now we're looking at seasonality. And this is a monthly chart for the spiders, okay? Each one of these candlesticks represents 1 month's worth of action. This chart's going back 5 years, this chart over here. And in the month of December, there is a 75% probability that you're going to close the month higher than when you opened it. Currently, for the month of December, you are up 0.87%. Well, there's a 75% probability you're going to close higher, so you only have 0.86% at risk when you look at this from a seasonality perspective. All right, what we are looking at right now is a 1-year chart for the spiders on the Think or Swim platform. In this, I also have standard deviations, +2, -2 in gold, +1, -1 in pink. The regression 50% line there, or the half midpoint, is at the dashed green line. Now we want to focus in on this area over here because I have a Fibonacci retracement that I want to go over in really good detail for you guys. And I got a couple of alerts that are being sent out here, but let's go ahead and open this up right here so that you can see this a little bit better. Also, I'm going to take this and stretch this out like this, and let me just bring that down for you like this so you can really get an idea of what's happening here. This tool that I use to draw this, when you come over to your tools down here, it's this one right here, Fibonacci extension, okay? So we have a Fibonacci extension that I drew from this low over here to this high to this low right here. When I move the cursor over here, you can see it highlighted. And it populates this, yeah, as a matter of fact, let's just remove the drawing and we'll draw it again, okay? So let's put that in, Fibonacci extension, come down here, grab a low point right about there. Come on, computer. Come on, why? No, I want this. And go over there. There we go. And we want to go to this high to this low, approximately there. And it pre-populates these Fibonacci's, okay? You'll see that we just pretty much are tagging the 78.6 right now with the Fibonacci, okay? And with that, and you'll notice how the way that the platform worked with Thinkorswim, they automatically changed the 78.6 to a red bar, indicating that that's a good target to hit, built into the platform. That wasn't me drawing that. That was them on their platform with the default settings, okay? So we came from this low down here to this high right here. If I change this over to a line, gives you and if I click here, and I click to the high point that we did right there, tells you on that pop-up dialog box that we've just increased 4.4% off of the highs. Now, let's just look at the last time we had a cycle, okay? So if I click down here, click up there, and look at the pop-up dialog box, 5.66. So we're about 4% right now. We could maybe tag this 100%. Let's see what that would take us to. That would take us to 5.62%. So it is very possible that this market could continue to go on from its current level up to 100 before showing signs that it's going to pull back. but I'm not feeling it. I'm not feeling confident in this market. Now I'll show you that later on, why I feel that way. But I'm feeling like this market is losing energy underneath the surface. Although it's not looking too bad on this chart pattern right here, but when I look at the individual sectors and I can see how those are breaking down, when we get to that slide, I'll show it to you. And then I'm not really feeling it. But I want to explain to you, and not only that, the 78.6 is already a good target to be hit. So generally speaking, we got the real good money to be made from this move already. Maybe there's a little bit left, 1.25%. I'm not willing to put the money at risk. I want to have some type of short position right now, but it could very well easily still continue on to that 100 before retracing back. Okay? All right, now let's switch over to a 3-year weekly chart, change our cycle brackets to weekly. So now you can see things on a 3-year weekly chart. And what I want to point out here is this, how we have a low point here, we have a low point here, and then I drew in this trend line right from here to here. Then the market began to increase its angle of ascent. So I drew in another support line right there from this low to that low, and you'll notice now how that is a higher angle of ascent. Well, this happens in blow off tops when you're starting to reach a market top. Okay, now we do have a resistance line right here, and we are just tagging that resistance line, and we are at the +1 standard deviation. When you're at the +1 standard deviation, there is now a 68% probability that you're going to bounce off of the +1 and start to head down. You can still head higher. There's a 32% probability that you can continue higher, but your risk, you have to recognize you're going to do so at greater risk. So do I want to put the portfolio at risk at this juncture? We've already made 4% in this cycle move. So I'm not feeling it like I was explaining to you earlier. Okay, now here's one of the main reasons why I'm not feeling it. So this is a spreadsheet that I created in an effort to try to determine the health of how different asset classes as well as the 11 S&P 500 sectors are doing. This is how I derive at the information right here, and then I populate the chart, and then we determine what the percentages are at the bottom. We also want to determine our current reading, and we want to compare that reading against last week. And last week for asset classes, we were at 59. Now we're at 48, telling you that various asset classes, from equities to precious metals to treasuries to emerging markets, are losing energy. I can see that energy is being sucked out of various asset classes across the board. What's left? The only thing that's left is equities. The S&P 500, the NASDAQ, and small caps. Everything else is looking really not good. So how much is it going to take to start losing energy in the indexes, okay? Now, look at your 11 sector breakdown here. Last week, we were at 86. This week, we are now at 59. Well, we know that anything that is 60 or below is going to be a yellow, and that's why it's yellow. And we are currently at 59. And last week we're at 86. So we know that the individual sectors are absolutely breaking down. So when is it going to show up in the S&P 500? Gee, I think it's going to show up in the next week or two. So do I want to put my money, again, at risk in this environment with this information? So wait till the last slide. I'm going to show you exactly how I want to trade this market. Now we are looking at TNX. It's a 1-year chart for the U.S. Treasury yields. Now that's the candlestick chart right there. In blue, we have the S&P 500, which is right there. And in black, we have TLT. That's an ETF for 20-year bonds. TLT, that's in black. Okay? And basically, when the yields travel north, the bonds travel south. And it is not uncommon for the S&P 500 to travel in unison with bonds during this time frame as well. So that would not be unusual, so to speak. Right now, bonds, if you look at in this thumbnail right here, bonds for the last 5 trading days really are just staying in this area. It looks to me like we're establishing a trading range of somewhere just below 43 and somewhere just above 41. We seem to be in this tight-knit group. So we're in this trading range until we break out otherwise. Now, the MACD is below its signal line, but look at the histogram. The histogram is going the other way, telling me that I don't think we're going to breach this low support level right here anytime soon. So I got a feeling that the 10-year U.S. Treasury yields over the next week or two are going to be traveling within this trading range or traveling sideways. Okay, that is going to take us to the conclusion of this video. December 7th, 2024, the market summation, according to me, Ken, your friendly host for SPY Trader Now. I see the market is deteriorating under the surface, noted by the yellow on the strength signal right there. Okay? There is a lot of cross currents going on. Bullish, you have the market making new highs. Risk is on. Fear is low. Bearish, you have a rising wedge on the weekly chart. The current rally is nearing a cycle peak with more risk than future profit. Nearing the cycle low in the VIX, and I showed you that. Asset classes in the S&P 500 sectors are losing strength. I just showed you that a couple of slides ago. I can see this market easily pulling back 3 to 5% over the next 2 weeks instead of moving up. And for that reason, I am wanting to close all my current positions and just sit in cash, not take any position, bullish or bearish. I'm just going to sit in cash. Cash is a position. It's a position to sit on the sidelines in safety while the market figures out what it wants to do. At this juncture, although the market's at all-time new highs, and you're going to hear bullish and bearish sentiments going both ways, I just want to sit out. We've made enough cash. We've made a nice fat 33.89% so far year to date. If we close the year out at 33.89%, we have absolutely no problems. I see no reason to put our portfolio at risk at this juncture. So I currently have 2 open positions. I'm upside down in one position by $46. I'm profitable in the other one by $178. So my intention is Monday, when the market opens, I'm just going to close out both positions. It looks like I'm going to be slightly profitable by $100 or so. Perfectly fine, unless the market does something totally screwy over the weekend. But if the market is at where it's at right now on Monday, I have these numbers, I'm just going to close the positions out, and I'm just going to sit there and watch the market safely from the sidelines for 1 week, and then see what the market does to determine what my next steps are. So that is my game plan. But I'd love to hear from you, the audience. Do you agree with that game plan? Do you have a better idea on how it would be better to invest over the next current week? Love to hear your comments as well on this exact subject, because what do we want to do here? We all want to make money, but this is my model portfolio and this is how I want to trade it. I hope you got some valuable information out of this video. If you have not done so already, go ahead, smash that like button down, subscribe to my channel, and ring that bell. I thank you and wish you good trading.